All eyes are going to be on the jobs data later today from the US economy, and that data will declare or decide whether the Fed will go in for the first rate hike on the September 18 policy or not. Lambregts, the global head of financial markets at Rabobank, joins us on the phone line from London to give us his view. There is some amount of caution in the system ahead of the jobs data today. What's the sense you're getting? First of all, what is your own expectation? And if the jobs data is strong, do you get a sense that the Fed may go ahead with the first rate hike?
Well, let's start with the last question you asked there first. I think there's a fairly high hurdle here for the Fed to already hike in September. They want to be just really sure they're not going too quickly. We saw that a few years ago when they had the taper tantrum, when they also made a lot of noise, but ultimately they decided to postpone a few months simply because they weren't sure enough. Now, they have highlighted in the past the importance of non-farm payrolls, but I think over the past couple of months it's become quite clear that disinflationary forces fueled by weaker growth in China and the downwards pressure on commodity prices that has resulted in is a real concern as well. So for today, two things to watch. Headline non-farm payrolls, and that could be better than expected. Anyone's guess, really hard to forecast that exactly, but even if it is stronger than expected, look at the second part as well, which is wage growth. Wage growth has been really weak, so even if the headline employment growth is good, if wage growth remains weak, the Fed probably doesn't have enough of a case. We continue to think they'll hike in December rather than September.
Jan, hi, good afternoon. Anecdotal evidence tells us that emerging markets normally actually bottom out after the first Fed rate hike. So in that sense, would you say that we are pretty close to the bottoming out process for financial markets, for equity markets, or do you think that would be maybe too straightforward an inference to draw, and we could be in for a slightly longer period of bearish phase?
No, it makes sense, of course, that people always fear the most what they need to time. So it makes sense that once that first rate hike arrives, that people start thinking, okay, that wasn't actually too bad, especially not since the prospect isn't that they're going to do a lot of tightening, etc. But there's a second factor here at work. It's not just the Fed; it is also China and weaker growth in China and what that means for emerging markets in general. I already highlighted that it's exerting downwards pressure on commodity prices. That means for the emerging markets that are exporting commodities, this is a real concern. But in general, China is an engine of growth, and some of the large emerging markets as an engine of growth is a theme that's under pressure. And that leaves many of these emerging markets exposed to capital outflows and portfolio reshifting. So I don't think it's as simple as if the Fed were to go in September, in October, it will all be rosy. First of all, we expect that they won't go in September, they'll go in December, so this is a theme for the rest of the year. Secondly, that China slowdown story is a theme that's with us for the next year as well. So that's one to watch too.
Okay, you were talking about the jobs number and the wage growth, but what about the unemployment rate itself? Because over there, it's fallen for the last many years, and now it's at about the lows of 5.2 to 5.3%, the US unemployment. Do you get a sense that over there could be more weakness, which will then prevent the Fed from hiking rates in September?
I actually think it could actually fall a little bit further. You're talking 0.1 percentage point lower. The problem here is I would actually put that in the employment box. So you got the headline employment figure together with unemployment versus wage pressures and wage increases that are coming through there. The issue with the unemployment rate is that the headline unemployment rate simply is underestimating the true unemployment out there. The problem you're seeing in the U.S. is that underemployment, so people marginally employed, people who would like to actually have a job but don't have one or don't have one for enough hours, don't have one that is commensurate to their experience, that is quite significant. So if you look at that sort of underemployment, and in technical terms they could call that U3 versus U6, that still stands at double digits.
Okay. Jan, I heard you say about the China factor. Do you think that still remains the biggest risk for equity markets? And do you think that there's still more to play out in terms of the kind of bear market we've seen in China?
If you look simply at equity in China, I'm not an equity market expert here, but I use a very simple sort of comparison in the past. I look at 2008 in China, when China went through a boom-bust cycle, quite comparable to what is playing out right now. I would actually say that right now there's more China-specific concerns, so that leaves us even more exposed. At the time, we saw the Shanghai index rise above 6,000, and it fell very sharply. It took a year to correct and fell to as low as 1,700 something. Now, that was a 72% correction. We've so far had a 40% correction, so that leaves you quite exposed to some further downside here, specifically if you consider that the concerns about growth in China are much bigger this time around and much more China-specific than last time around when it was the global economy under pressure.
Okay, and we'll leave it at that. Thanks for joining us. That's the word coming in from Rabobank. They don't believe the Fed will hike rates in the September policy. They think the first rate hike will come in the December policy.